So welcome everybody to this next edition of Market Matters. Today is October 5th, 2021, and today we're going to be conducting our quarter in review. A little bit different than the normal Market Matters as we go through some more unique performance data, but nonetheless, I think it's going to be a good outing and afternoon. Briefly, the agenda for today, we actually have Hank McLarty, our CEO and founder, joining us for the first bit to give an update about what's going on with Gratus. We'll talk about some of the economic updates that we see out there right now. And then finally, we'll touch on the Q3 review as well as the investment outlook. As always, if you have any questions, please feel free to lob those into the question queue in the chat feature. I'll grab those off and try to address those throughout the course of this discussion. So with that, I'll turn it over to Hank McLarty, our founder and CEO. Hank.
Yeah, thanks, Todd. It's good to see everybody virtually. One of these days, we can stop starting the initial comments of the meeting mentioning virtual. We are sure excited to see everybody in person soon, and still trying to plan right now for some possible in-person general market updates like Todd's been doing here on Market Matters. But we're still taking indications of interest from clients to figure out if this is something that everybody's comfortable with. And so hopefully we'll be planning something maybe the first or second week of December, depending on the response we get from clients. But I wanted to give you just a couple of general updates with the firm. I mentioned in the last market updates and Market Matters update in August that we were excited about our upcoming move to our new headquarters here in Atlanta, and yesterday was our first official day in our new office. So I'm very excited for any of you to come visit us. We have state-of-the-art technology that's going to allow us to provide a great meeting experience, both in person or virtually. We took down an entire floor in the building that we're in. So when you get off the elevator, you're standing in the middle of our office. So there's not much exposure to people when you come visit us in the office. We have plenty of parking in a secured parking area, and it should be very comfortable and convenient if you choose to come visit us sometime soon. We'd love to see you. So schedule a time with your advisor to come in and do a review, or just come have a cup of coffee with us. But we're very proud of our new office. And like I said, we'd love to see you. So I know all of you are hearing a lot about tax law changes coming, both with income, investments, capital gains, trust and estate. So there's a lot of unknowns about how all this is going to play out. And certainly there are all kinds of different scenarios being talked about in the news and the markets and so forth. So I just wanted to reassure you that regardless of whatever the final decisions are with the outcome of all these changes, there's going to be a lot of the changes. So our investment and planning team, we're on top of the changes. And once we figure out how this is going to play out, we will be ready to advise you on how to best manage your situation effectively. But as you know, with our government, how this thing is going to play out is anyone's best guess. And we will be able to give you solid advice on making decisions both at the end of this year and going into next year. And then finally, I wanted to mention that part of our vision as a firm, part of the vision that I cast for our firm is not just growth, but it's also the top priority is our client experience. And so in order for us to achieve our vision, part of it is that our client experience stays strong and even improves over time as the firm grows. And so the way that we get that feedback from you, our clients, on how we're doing is through a brief survey that many of you participated in. We did our first one in July of 2020, and then we did our second one in January of this year. And what we call it internally is a Net Promoter Score, or NPS for short. But this is a direct feedback tool that we can learn about your experience with our firm. It's pretty brief. It only takes a couple of minutes to fill out. But I wanted to mention it now because the next time we give you the opportunity to give us feedback in this Net Promoter Score tool will be in January, in just a few months. And this is critical for us to get this information back because it gives you a place to give us personal comments about your experience. Do you want more communication from us, less? Is there something else we could be doing to make your experience better? And this is a great feedback tool for you to give us direct input on how to make your experience better. I do want to mention that when we did our NPS scores this past January, we scored a 91. And apparently the only company out there that scored in the 90s before is Tesla. Most of the companies in our industry score somewhere in the 20 to 30 range. So you gave us feedback that we're doing a great job, but we always want to improve. And many of you gave us feedback on things we could do to make your experience better. And then we took that feedback and made changes. So I strongly encourage you to take just a couple of minutes in January. Your advisor and your team that you work with are going to be bringing this up and talking with you about that over the next several months. But I strongly encourage you to take a few minutes and give us some feedback in January so that we can continue to improve the relationships that we have with you and make your experience great. And with that, I know Todd has lots of comments about the increased volatility we've seen in the market and what to expect. And I'll turn it over to Todd now. Thank you.
Great, thanks, Hank. As I mentioned earlier, part of this journey we're going to be on today is an economic update, which will review a few key slides or a few key concepts that we think is informing our opinion about the direction ahead. And then we'll touch on the outlook. So let's take a look at some of the economic picture. And I just thought we'd start with, some of the basics here. So I think by all stretch of the imagination, a 6% growth rate is nothing to sneeze at. So what you see in front of you on the screen is Federal Reserve projections of a few key things. One is growth in the economy for 2021. That's this GDP metric. The next is the unemployment rate for 2021. And then PCE is the personal consumption expenditures, which is really another measure of inflation that the Fed keeps track of. And while we realize that the Fed has a pretty abysmal track record of forecasting, it's just useful to see what at least policymakers are thinking about, because that does help inform the consensus. And I think by and large, what you'll notice here is that beginning even as early as March to where we are today, there's been a pretty noticeable deceleration of growth. Now, it's not negative growth, right? I mean, it's not a negative number. But it is a lower number than the Fed and others were expecting earlier in the year. So that's important to understand, because it's a deceleration, a decelerating economy. And we always knew that, right? It was the pig in the python analogy that I was using earlier. Also, they are targeting a higher rate of unemployment, steady state. As you all may be aware, this is something that we've been talking about as well too, and that there are just going to be some people that don't want to go back to work because of the health concerns or considerations or skill atrophy. And I think this is an important feature of not only debt load management at the country level, but also things like what are going to, longer term bond yields going to do potentially. And then finally, the inflation rate. This is a big item to talk about. The PCE is not really a great metric to use, but by and large, or needless to say, we've got a rising inflation trend for 2021, which I think we all would expect that as well too. But on the surface, still a pretty positive picture. I didn't have a chance to update the services index, but this is actually the manufacturing index that came out yesterday. And I think what's important to note here is that while we did see some deceleration from March to May and into September, or into August, September actually saw an increase in the service in the manufacturing sector for the month of September. And I think that's actually leading a lot of folks to believe, including us, that Q4 might actually be, despite what some of the economists think, a positive upside surprise for the manufacturing sector. And also the services number, which came out this morning, saw a slight uptick in September as well too. So near term, we've got some very positive tailwinds, which are usually generally pretty supportive to be investing around. The debt ceiling, I know, has been an item that a lot of people are concerned about because this does have a way of creating some anxiety or volatility around these periods. This is a chart that I took from Fidelity, and I think they did a great job of capturing the last one. And you can see here in the yellow bar the actual debt ceiling, and then you've got the blue bar, which is total public debt outstanding. And so, what you can see here is a pretty lockstep approach pre-2013 of raising the debt ceiling just based on the needs of the country. And starting in 2013, I think that really catalyzed the making the debt ceiling a political lever to use from the opposing party, whichever one that might be. The last time we did have a debt ceiling issue was 2013. This was around the infamous Obamacare passage. And what ended up happening was there was a I think a default for about 6 or 7 days, and then of course a deal was reached between both parties, and debt was repaid in full and things of that nature. The consequence of that, however, was that S&P downgraded the U.S. from a AAA bond rating, which was the highest credit quality bond, down to a AA plus. Now that's still in really rarefied air if you look at it across the globe. But I think, if there would be any issue with the debt ceiling this time around, I think maybe the natural consequence would be another one notch downgrade from AA plus to AA. It's not a significant event. Certainly it can cause volatility, no question about it. But by and large, we're believing this is going to be a situation that'll be sorted out, and one in which the debt ceiling will ultimately be raised. And I think also there's a little bit of a misconception as to when the government's actually going to run out of money, because policymakers like Janet Yellen, who's in charge of the U.S. Treasury now, paradoxically, is saying that there's the Treasury is going to run out of money sometime around October 17th. But if you actually take into account the fact that they can move money around between some of their accounts, defer bills on some outstanding items that they have on the docket, paying Social Security payments later in the month, things of that nature, that they really have somewhere between October 25th and November 7th, according to a recent study from Piper Sandler. So not nearly as looming as one might think, but still, it's important to keep in mind that this will be front and center for a lot of financial news media. It's just going to be a lot of noise, in our opinion. And one just sector I would continue to focus on and do continue to focus on is the single family housing sector. And that does, it continues to be a bright spot with, I think CoreLogic came out with their price index this morning, showing that the average home increased by 18% year over year. Those are obviously, unsustainable price gains in perpetuity. But I do think there are some things to keep in mind. One is that this is what you're seeing on the chart in front of you is the home price index divided by median household income. Just basically gives a rough gauge of affordability. And certainly, this does appear this like 2.5% to 3% number would be the average range that housing affordability is traded in within a number of years going back to 1976. And now we're kind of above that. Still not at the levels that you saw in the kind of housing boom from 2004 to 2007, but we're getting close. So nor do I think that we're going to have some sort of housing boom like we had the last time around, because of course, we always don't want to be fighting the last battle, of course. But this time around, of course, it's going to be much different from a down payment perspective. And this pent up demand, I think there's a supply shortage causing this price unaffordability, and also inventories to be at some of the lowest levels they've ever been. But having a supportive housing market has many tentacles, and I think that's still very positive for the economic outlook in particular. And one thing I would also mention too, the second sentence here, is that private equity was never involved in single family home ownership prior to the housing crisis. Private equity only got involved when Blackstone, I think, first stepped in 2009 and 10. And that's a new buyer, it represents a new buyer to the market. And so you almost have to take what happened before this time period, before Blackstone entered, with a little bit of a grain of salt. And so therefore, very similar to the way housing prices are overseas right now, where you have other buyers that are interested, things like, Sydney, Australia has a very large contingent of foreign buyers. When you add new buyers to the mix, that just has a way of keeping prices higher than you might normally think. And then it might be a while until prices normalize back down to this target range. So let's take a look at Q3. Right now, we're just going to run through some index return numbers, and I'll make a few comments, then we'll go into our outlook. And again, if you do have any questions, just lob those into the chat feature, and I'll grab those as we go along. But Q3, you can see actually just barely squeaked out a gain for the S&P. That's this black line right here for US stocks at 0.6% after having been up roughly 5.5%. What changed during September, you might ask? Well, really, a couple of things changed. One was that the US dollar started to rise again, despite a lot of contrary indications from the economic picture. And then also interest rates started to rise again. So it does just shine a light on how sensitive financial markets are right now to changes in interest rates. But you can see large international companies did a negative 1.1%. Small companies, after having a great start to the year, were off 4.3% in the quarter, and then emerging market stocks, driven primarily again by China, were down 8.6%. And as you may be aware, we have the majority of our concentration in these top two categories. No exposure to small cap, and a very, very small position in emerging markets. And we might even exit that position just for tax loss reasons in some cases. But we'll primarily stay US focused for right now, given some of the dynamics at play in international waters. Fixed income markets, it was a bit of a challenging market for, broadly speaking, for the fixed income markets. This is, as you may be aware, something that we've been looking for throughout the course of the year. Junk bonds were the only bond category to have a positive return at 0.5% for the quarter. High quality bonds, this is the investment grade bond index, this is the aggregate bond index, mixture of government and corporate bonds, was basically flat for the quarter with a 0% return. The longer duration investment grade index was down 40 basis points, and emerging market bonds, which we've not been a fan of, were actually down 1.2% after being up close to 2% earlier in the quarter. And you can see it was just a pretty sharp sell-off towards quarter end, which drove a lot of this downside in bond prices. And then finally, I do like to point out some other things that are going on within the markets that might be outside of stocks and bonds. One is that commodities had yet again another very strong quarter, up 8%, driven primarily this time and still by energy prices. Energy prices, just for reference, the natural gas sector, as you may be seeing on TV right now, with Europe having a natural gas crisis essentially, and crude oil are both up over 100% for the year. Actually, crude oil and natural gas specifically in Europe, natural gas is up over 200%. And in the case of the UK, it's up over, I think, 300% year to date. US REITs actually had a really big and sharp sell-off toward the end of the quarter, up at 1.9%, and then just to barely break even for the quarter. And this is what I was talking about. The US dollar had a pretty decent move towards the end of the quarter, up 2%. And the importance of the dollar really can't be underestimated, because it is the world's reserve currency. And so if the dollar is rising, every currency by extension, almost every currency, is likely falling versus the dollar. So this has a kind of capital constricting impact on a lot of foreign currencies and assets. So let's move on to the investment outlook. Investment rating wise, we only had one change, I think, for the quarter ahead for Q4, and that is to move emerging market stocks into an underweight position. This is, of course, at the index level, and we'll get into why that is. But by and large, everything's pretty much stayed the same since the last quarter, where we've got a bit of an underweight to fixed income, broadly speaking, no exposure to emerging market debt or junk bond debt, for that matter. And then we last quarter recently upgraded alternative strategies another notch, given that bond yields actually started to rise during this year in a pretty meaningful way. So, rotating out of these and into alternatives is, I think, the right answer, and the investment committee thinks is the right answer. And of course, we still have our main exposures within US large companies, and then have on the back burner right now a mid-cap or mid-company active strategy that we're looking to implement at some point in the not too distant future. So here are just some general notes or ideas about how we're positioning for quarter ahead, or even year ahead for that matter. We are looking to absolutely take advantage of increasing volatility. We were able to execute yet another small scale rebalance as we hit our rebalance target across in Q3, and I think that was when the S&P hit 4,500, I believe was our target level there. We'll certainly update you with new levels as to what that would look like. We have yet to decide that, the investment committee, but just another example of ways to essentially de-risk the portfolio while staying invested. We are looking at tax loss harvesting opportunities. I mean, certainly capital gain levels will likely head higher in 2022. Everyone kind of realizes that. The question is how much and when those will be effective. So, you may be aware we've actually taken some gains earlier in the year, and we're certainly looking to try to offset some of those through the balance of the year. And then, of course, in any fixed income positions that might have a loss of small sorts, we'll look to harvest those as well. And what are we doing with some of the cash we're creating? Well, we're either putting it into more liquid positions like cash equivalents, raising cash, or even to select alternative strategies, which I'll touch on. And we do have, just as a reminder, we do have our private markets webcast next Tuesday that Patrick and I will be conducting. So we hope you can tune in. Equities wise, we still have a very similar exposure to the way we entered the year, and a substantial underexposure to emerging markets, which was additive to the portfolio. And a lot of that can be seen in the price of Evergrande. That's just the soup du jour in China right now. But it's just a useful reminder of some of the opacity that occurs in those markets and why we don't like them unless they're extremely cheap. And then we are maintaining positions. I think one of the key things that we're doing, of course, is trying to change out positions when it makes sense, or in our active strategies, trying to realize gains or losses given the higher volatility. But we do think that having equity exposure is going to be good, particularly into Q4, because there is some seasonality to Q4, but also I think there's a number of other tailwinds that are out there, which we could touch on here in just a moment, that I think will make for a pretty positive Q4. Fixed income, we're still keeping this as a higher quality strategy. Recall that now our fixed income allocation is meant for capital preservation. So therefore, we've got a bit shorter of a duration than we have had in years past. Still generating some income, but obviously not to the levels that we are used to in prior years. So that's why we had recommended as an investment committee that clients carve some capital out of their fixed income and allocate it to either liquid alternatives or private alternatives. Inflation is still a big question mark, despite I think what we're seeing in commodity markets. It's still a question mark. And we do see the migration in inflation back to a trend level over the intermediate term. Shorter term, with the way gas and energy prices are trading, we could see energy pushing CPI or consumer prices up, from here. But longer term, we still kind of believe that demographics, technology will be very deflationary into the future. And then finally, on the alternative side, lower levels of bond and equity volatility do present good opportunities to add to our existing strategies within these buckets that benefit from rising volatility. These are when alternatives tend to shine. Income generation, that's also becoming more important for alt income positions and across private strategies. And we are happy with some of the progress we've made on that front. And then I think I may have mentioned, we are working on a private offering that we'll share with clients at some point down the road, where we are looking to capture opportunities across not only digital assets, things like Bitcoin or other related strategies, but also things like venture capital or even non-correlated growth strategies. The other name for those would be hedge funds in the old days. So that's kind of where some of our priorities are at the moment. Turning to global stocks, this is a year-to-date picture now. And you can see it's still been a pretty positive year for US stocks to the end of Q3. Again, this is the S&P 500 here. We're up 16.5%. Small caps have really traded sideways for the better part of almost 6 months now, kind of in this downward trend. Recall, we don't have any small cap exposure. So again, having this US large exposure has been additive. International positions, we still find, attractive given their much lower valuations than both US or US large or small, but still, underweight relative to what would be the global portfolio, targeting about 25 to 30% of our equity exposure. And then finally, you can see emerging markets, after they started off really strongly for the year, are now at a negative position. What happened here, of course, was this was in I believe the time when China nationalized their for-profit education sector. And then, of course, Evergrande started to become a problem within their real estate sector right around here. And it's just been, a bit of a one-way grind down for emerging markets. Again, we have very low exposure here, and that's been quite additive to our portfolios. For the US side of the house, earnings drive stock prices. You can actually see that in this chart here. You got to look very carefully. And what you're seeing here is a chart of Q3 earnings estimate as they progressed throughout the quarter. So this is June 30th. This is September 30th. This is the price of the S&P and the dashed blue line. And what you'll notice is really once U.S. earnings stopped going up from an estimate standpoint right here at about the first part of September, the S&P really did start to turn lower. And that's also about the same time that the dollar started to rise. So despite we had a 5% growth in earnings for the quarter, we only had a 0.6% change in the S&P. Now that's actually good in our book because it's making valuations even better. So, I believe we started off the beginning of the year at a PE ratio or forward PE ratio of 22 on the S&P, which of course is much higher than historically we've come to expect. And now it's hovering now in that low 20 point something forward-looking PE, might even be in the teens now. But I think even though earnings are leveling off, Q4 maybe the punchline here is Q4 with some of the uptick in services and manufacturing sector does point to the fact that we'll get better earnings in Q4 and then potentially a really nice move up in the S&P. Although one thing I did want to point out, I have had some clients ask about valuation concerns. This is just another way to think about it. And what you're seeing here on the screen is the composition of sectors in the S&P since 1975. And I think this is a really useful way to look at it because there are a few things to tease out here. Number one, you can see in 1980 when energy and inflation was all the rage, energy made up at its highest point 26% of the S&P, if you can imagine. That's when ExxonMobil, Chevron dominated the Dow and also the S&P 500 from an allocation standpoint. But look at where they are today. They're only at 3% of the S&P 500. That makes sense, of course, but it also suggests that the S&P earnings, by extension, are going to be much less cyclical in nature if you have less cyclical allocation in your index. Same with materials. You can see the materials index right above it has come from about a 10% weighting in the 70s and early 80s down to about a 2% weighting. So think mining companies, copper companies, things of that nature. And what's replaced those in weighting, obviously, has been the information technology sector. This is profitable technology, by the way, not the unprofitable technology, which we saw back here in the 2000s. But it's the FANG stocks: Facebook, Amazon, Netflix, Google, and whereas maybe 5 years ago, some of those companies I just mentioned were not profitable from a GAAP perspective, all of them are now. Netflix, Amazon, Google are all very profitable as of 2021. And then communication services, this is really the old telecom industry, but it's also added in companies like Facebook, which are really hard to categorize as information technology, or Snapchat and things of that nature fall into this category or this bucket right here. And you can see that category has grown in size, not too much, but by a pretty decent amount. So what this means is that in the future, because you have higher profit margins within tech and higher revenue growth, you also could have or support higher valuations than maybe what we saw in the early 80s. The early 80s, by the way, the S&P PE ratio because of inflation, 1981 was something like five times earnings. This is when Warren Buffett made very large purchases for Berkshire Hathaway and Coke and other American Express and other companies. And of course, now today we're at 20 times earnings, which is much higher than the long-term average at about 17. But I think this chart in my mind helps crystallize a few things about what's changed over the last 20 years or 30 years that allow for slightly higher valuations. And then this is just a chart I found that does speak to the Q4 seasonality phenomenon. We don't like to make investment decisions based on calendar months necessarily, but I think there is some history to suggest that even with the first 8 months of the year being as high as they've been in the S&P up at 21%, 21.6%, this information was through August. There are periods, by and large, a majority, where you see the last 4 months of the year being positive by about 4.5%, or for all these back to the 20s, it's 3.2. So Q4, for whatever reason, pension funding, 401k, contribution maxing out, things of that nature allow for, stocks to be very positive into the Santa Claus effect, as they call it. And then other supports, I think, for valuation elevation are what you see on the screen right here, which is M&A, mergers and acquisitions, which is on track for the best year since 2007. Now, again, I know there's lots of people probably concerned that, this is a high watermark, right? 2007, right before the market collapsed. And there's certainly, I certainly take, this chart with a grain of salt, of course. But I think what's really changed since 2007 has been that this red dot has moved from 25% to 40%. So what is this red dot? This red dot represents the amount of private equity participation in mergers and acquisitions by year, right? So the dark blue bar represents strategic or corporate buyers that are being active in mergers and acquisitions. So think most recently, Home Depot agreed to buy Home Depot Supply (HDS) for a very large sum of money. That would be a blue transaction, a dark blue transaction. A light blue transaction is what they call a sponsor-driven M&A deal. And a sponsor deal is a company like Blackstone or Carlyle Group, or any other private equity fund, Brookfield, taking a company private because they find the business attractive. And so what this chart shows you is, and this is what we suspected back in 2008 and 9, was that private equity was going to be much more important to things like small company valuations, or even now large company valuations, because now private equity represents a much higher percentage of M&A volume than it ever has. It's at 40%. And honestly, I don't see that changing anytime in the near future, because interest rates are driving a lot of longer term buyers like pension funds, endowments, insurance companies into these longer duration private equity assets, as opposed to having primarily fixed income being there to fulfill liabilities down the road. So this dynamic also supports, relatively elevated valuations potentially, and it's something that I think is going to be a factor with us for a while. I do want to push along here because I know we're going to be close for time, but I got about a few more minutes. International stocks, Chinese stocks. This is one reason that we've always had a problem with China and Chinese stocks. And what you see on the screen here is the composition of what Evergrande, the company that's currently having a ton of problems right now in China, actually owns. So the red box right here, this real estate business, is actually the business unit that's having a lot of issues. Unfortunate for Evergrande, it's they've been a known bad actor for a while, but looks like they're going to take a massive write down on their business here. But this other interest that they own, that Evergrande owns, they own 2 technology businesses in various sizes, property services groups, development groups, and renewable energy group, and a car group. And even banking assets. So all this web of assets that Evergrande owns, it's all interconnected, is very opaque to understand who owes what within the web. And I think this is just this lack of transparency and ownership structure in this conglomerate business model just makes us not very keen on investing in these companies. And they should command a discount, frankly, because of this opacity. But it's important to understand why China is supporting or will probably not let Evergrande get out of control. And what you see on the screen here is house price to income ratio by city. Now, I showed you this price to income ratio earlier in this slide, in the 3 to 4 times range on average in the U.S. We'll look at what we have here. We've got the top 5 cities in China are all above 30% in price to income ratio by city. So just something that, to keep in mind is that this is actually what the Chinese are trying to get under control. And it's one reason why it's our belief that, the government of China won't let, Evergrande get out of control. And, a final point I would make on international stocks is that it is a pretty disparate picture between asset categories or country returns, for that matter. The black line is the Chinese index. This is a year-to-date picture, by the way. The red line is the Indian market. And then you have a few others in between, like blue in Vietnam, Thailand in pink, and Malaysia in green. And this dispersion actually is really attractive for a number of different reasons, because if there's disparate returns, then I still think we want to have some exposure there. We just need to find some active strategies that can avoid some of the black and green and add to the blue and red. And then finally, moving to fixed income, continues to be, this is a year-to-date picture. You can see the average return in some of these categories in fixed income is right around -2% for the year. Our strategies have actually held up far better than that, even positive in the case of our tax-exempt strategy, and just flat for our taxable strategy. So we're actually pretty happy with that performance so far. But I think it just does underscore the de-emphasis of fixed income right now to move towards that capital preservation mode as opposed to return seeking. So, and what's driving a lot of this is, inflation concerns. But, honestly, I think, when you look into it, yes, commodities are rising, but inflation concerns may be a little over exaggerated. And I'm not necessarily talking about what the Fed is projecting, but we look more at what markets are expecting. And still, this is the 5-year implied forward inflation rate. It's called the five-year forward. It's a market-based gauge. And what you can see here is that the market is still not projecting anything that substantial above 2.5%. It's between 2 and 2.5. So with that as the baseline, this is in 5 years. So by 2026. So as a baseline, you have to kind of use some of these market-based indicators to inform where things are going. And I think the market still expects, by and large, inflation to be pretty tame within that 2 to 2.5% range. Now, we do want to make sure we underscore, what's going on in commodities. This is something to think about. This is a chart of the CRB commodity index. I actually showed this chart in the most recent Market Matters, or maybe it was two weeks ago. But this is a long-term chart of commodities going back to the 1980. And what you can see here, it actually, if you were to draw a regression line, it's actually a slight downward slope in commodity prices. But there does appear to be a bit of a turning point here that started around COVID and moving upward. And I do think, some people are asking, is this going to be like a 2002 to 8 phenomenon, an up move, or 2009 to 11? Well, we have already experienced a pretty remarkable up move in commodities from the low, up about 100%. But it wouldn't be too surprising if this were to go up, a bit further before topping out, because there's been a substantial amount, for anyone that's following the commodity sector, there's been a very substantial amount of underinvestment in finding new commodities. A lot of that has to do with the green movement or ESG movement, which is fine, and that's by design. Where the ESG movement is making carbon more expensive, but the byproduct of that, of course, is that things that we use today are likely to get more expensive. So, this shouldn't be any surprise that, ESG or environmental regulations or concerns, requirements are now increasing the price of carbon. And then finally, you're probably all very sick of hearing me talk about this, but high yield bonds are one of those canaries in a coal mine that we tend to follow pretty closely, because the bond market, in our opinion, is the market of truth right now. And what you see here are high yield bond spreads as they relate to the treasury rate. And we're kind of at this low, very low level seen going back to 97. And again, if we're at this low of a level, we did pop up to a decent range during COVID, but it was a very fleeting moment. And until we get back to a more normalized level where spread potentially over 5, even 6%, we're just not going to be that interested in high yield, because the high yield bond prices can change very quickly. And then finally, I just did want to mention before we conclude today, and I certainly can take some questions if you have any, but I just wanted to mention that this is a better market for alternative strategies, because low volatility is where you want to be owning indexes and just straight market beta, very simple market beta positions. But higher volatility levels, like the type that we started to see starting in 2018 into 19 and furthermore into 20 and 21, it does appear we're starting to enter a higher volatility regime, if you want to call it that. And if markets are going to have higher volatility on average, there are two outputs of that. One is that we're going to have to be, holding on to positions, and it's going to be more uncomfortable to hold on to positions, but we can't let volatility shake us out of longer term convictions. But also number two is that for alternative strategies, particularly some that are maybe long and short at the same time. This is a great environment because dispersion between stocks, even within sectors, the same sector is very wide this year, and it's growing. And so that just bodes well for not only active strategies on the long equity side, but also alternative strategies. So with that, I just wanted to leave you with a few key takeaways. One is that we still continue to favor stocks over bonds. I would encourage you to take a look at our capital market forecasts that we published in January of this past year. Also continue to favor alternative strategies now over bonds. So moving that bond allocation into more of a capital preservation role, and therefore a smaller role by design. We are, again, incrementally raising cash. So we're doing that through rebalancing opportunities. It might even be through tax loss opportunities that we continue that. But patience is, I think, one of the only ways to capitalize on what we see as greater volatility in the future. And we want to be ready for that. And then finally, we do want to put an effort on continuing to find ways to access some of these newer asset classes or strategies that were previously inaccessible, likely going to be in a private format, because that's we still have no approved Bitcoin ETF or mutual fund that we want to own that's not a futures-based mutual fund. But we're looking at private options that in that regard, and we'll certainly keep anyone apprised of as we develop that in the future. So with that, I'm just going to pause here real quickly and see if you all had any questions about what we're up to or how we're positioning things. And certainly want to thank you for your time up to this point. So it looks like we do have one question already in the queue, and I'll go ahead and address that now. It says, assuming Congress does pass some sort of fiscal bill, how do you see the markets responding? Well, thank you for that question, Stuart. I think the devil certainly is going to be in the details. If it's a fairly punitive bill that's maybe not as investor friendly as maybe some are contemplating, meaning a much higher shift higher in short-term capital gains rates or long-term capital gains rates, then that likely would create some repositioning and tax changes through the latter part of the year. So if it's for selling that's being created by tax reasons, then certainly that could put some downward pressure on stocks. The other point I want to make is the implementation date that's also been kicked around as being effective, September 30th in some cases. I think that's a very low likelihood, but if that were to be put in place, then obviously I think we would have a bit of a wild ride in Q4. But remember, I think there are some structural supports for the market, and I'm not talking about the Fed, but one was I'll just review them just briefly. But number one is that relative to bond yields, I think stocks still make a lot of sense as long as we can handle the volatility. So we have to be ready to capitalize on those opportunities. That's the first point. So that's number one. The second point I mentioned is M&A volume is very supportive right now. So we've got a very high degree of private equity and rising involved in the markets right now, and I think that's going to continue to be with us for quite some time. And then finally, this is more internal M&A, but the buyback mechanism for corporates right now is set to be this, some of the highest ever potentially. So companies are choosing, instead of in a lot of cases dividends or capex, they're choosing to buy back shares in the face of uncertainty with the operating environment. And it's just a massive support. Something like $500 or $600 billion worth of stock will be purchased over the course of 21. It's a very substantial number to try to overcome with sales. So I think from that perspective, we still see quite a few supports for the market that doesn't necessarily give us too much concern about a middle of the road tax bill. Now, again, if it's investor unfriendly, then that might be a whole different ballgame, and I would expect to be bringing you all updates as we go along in the November market matters. And that does remind me, the next guest we're going to have on is actually Charles Schwab's chief political consultant, Mike Townsend, who was on, I think at this point last year, as we were going into the election. So please do mark your calendar and tune in for that interaction and that exchange, because I'm going to be asking Mike all of these questions. If we have a compromise bill or something and they need to pass something more substantive, I'm definitely going to be asking a lot of these questions. So it doesn't look like we have any questions in the queue. Thank you for allowing me to go a little bit long today. We did have a lot of ground to cover, but I want to thank you for your time, and we'll see you next month.